On Wednesday, March 8, 2023, Silicon Valley Bank was a 40-year-old institution with $166 billion in deposits. Its regulator would later describe it as being in sound financial condition. By Friday morning, it didn't exist. No rogue trader, no hidden fraud, no secret hole in the balance sheet that nobody knew about. The thing that killed Silicon Valley Bank was something much simpler and much scarier. Because what happened in those 48 hours had never happened before in the history of banking, and it can now happen to any bank on Earth. This is the story of the first bank run fought at the speed of a group chat. To understand why SVB died so fast, you need to understand what made it unlike any other bank in America. Most banks have millions of small customers, salaries, savings accounts, mortgages, boring, diversified, safe. SVB had the opposite. A relatively small number of very large customers, startups and the venture capital funds that backed them. It was the Bank of Silicon Valley. When a founder closed a funding round, the money landed at SVB. When a venture fund wired millions, it moved between SVB accounts. And that concentration came with a detail that will decide this entire story. Roughly 93% of its deposits were uninsured, above the $250,000 limit that federal insurance protects. Remember that number, 93%. Because deposit insurance doesn't just protect depositors, it protects banks from their depositors. An insured depositor has no reason to run. An uninsured one has every reason to run first. SVB wasn't a normal bank with a normal risk. It was a $166 billion pile of nervous, uninsured, hyper-connected money. Now, the seed of the collapse, planted years before in the most boring asset on the planet. During the zero interest rate years, deposits flooded in faster than SVB could lend them out. So the bank did what looks, on paper, like the safest thing possible. It bought long-dated government-backed bonds. Not crypto, not junk debt. The assets your textbook calls risk-free. Here's the trap, and it's worth 30 seconds of your life, because it's the same trap hiding in every bond you'll ever own. Say you buy a bond that pays 1.5% a year for the next 10 years. The next year, interest rates jump, and new bonds pay 5%. Now try selling yours. Nobody will pay full price for a bond earning 1.5% when the one next to it earns 5%, so the price of your bond falls until its return matches the market. Same government guarantee, same coupon, less money. That's not a default. It's arithmetic. And starting in 2022, the Federal Reserve raised rates at the fastest pace in decades, which meant the market value of SVB's enormous bond portfolio quietly sank month after month. On paper, SVB was sitting on billions in unrealized losses. But, and this is the part most retellings skip, an unrealized loss doesn't kill a bank. Accounting rules even let you hold those bonds in a bucket labeled held to maturity. As long as you keep them to the end, you collect every dollar, and the loss never becomes real. It only becomes real if you're forced to sell early. And you're only forced to sell early if everyone asks for their money back at once. So here's the mystery restated. A bank with a known, manageable on-paper problem, the kind regulators watch but don't panic about. What converted it into a corpse in 48 hours? Wednesday, March 8th, after market close. SVB announces it has sold part of its bond portfolio at a $1.8 billion loss, and that it plans to raise fresh capital to plug the gap. As an accounting event, it's survivable. As a signal, it's a flare fired over Silicon Valley. The bank needs money. Thursday, March 9th. This is where history changes. The bank's depositors weren't millions of scattered savers. They were a few thousand founders and investors who all read the same feeds, sit in the same group chats, and answer calls from the same venture funds. Some funds began advising their companies to move money out. Screenshots traveled. Nobody had to line up outside a branch in the rain. The run happened on phones, between meetings, in silence. In roughly 8 hours, depositors requested $42 billion, about a quarter of the bank's entire deposit base, in one working day. And think about what that money was. For thousands of startups, the account at SVB wasn't an investment, it was the operating account, the money that made payroll. Founders weren't asking, is my bank sound? They were asking, do my employees get paid this month if I'm wrong? When that's the question, you don't wait for the answer. You click. Friday, March 10th. The requests queued for that morning reached $100 billion. No bank on earth holds that kind of cash. Before noon, California's banking regulator closes SVB and hands it to the FDIC. From announcement to death, about 44 hours. What happened next tells you how scared the people in charge really were. On Sunday, before Asian markets opened, regulators in New York closed a second bank, Signature, citing systemic risk. That same evening, the Treasury, the Federal Reserve, and the FDIC jointly announced that every depositor at both banks would get every dollar back, insured or not. The 93% were saved by an exception designed for national emergencies. And the Fed went one step further, a step that proves the thesis of this video. It created a brand new lending program, the Bank Term Funding Program, letting any bank borrow cash for up to a year against its bonds, so that no other bank would ever have to sell its portfolio at a loss to pay fleeing depositors. In other words, the entire mechanism that killed SVB was bricked over for everyone in a single weekend. Regulators didn't get 2 days to save SVB. They gave themselves 1 weekend to save everyone else. Weeks later, First Citizens bought the remains, $119 billion in deposits, $72 billion in loans at a $16.5 billion discount. And the cleanup cost the deposit insurance fund an estimated $20 billion. So, solve the mystery. Was SVB a badly run bank? In some ways, yes, but badly run banks usually get months, regulators, buyers, rescue weekends. SVB got hours. Compare the 3 great American bank runs. Continental Illinois 1984, the original too big to fail. Big uninsured depositors, electronic withdrawals, the fastest run of its era, about $10 billion in 10 days. Washington Mutual 2008, the biggest bank failure in U.S. history, mid-financial crisis, $16.7 billion in 9 days, roughly 10% of deposits. Silicon Valley Bank 2023, $42 billion in 8 hours, 25% of deposits, not in a week, in a working day. That's the real story. SVB didn't just fail. It failed at a speed that made every existing safety mechanism obsolete. Bank regulation was designed for panics that unfold over days, time to arrange loans, find buyers, calm markets. Nobody designed it for a depositor base that shares one group chat, banks from an app, and can empty an account between 2 meetings. The tools assumed money moved at the speed of paperwork. In March 2023, it moved at the speed of a push notification. Since that weekend, regulators have debated faster backstops, and every bank treasurer in the world has quietly reread the same spreadsheet. How much of our money could leave in one afternoon? Because here's the uncomfortable ending. The conditions that killed SVB, concentrated depositors, uninsured balances, instant banking, viral information, didn't die with it. They're features of the modern financial system, not bugs of one bank in California. The first internet speed bank run has already happened. The open question is whether the system got fast enough before the second one. If you think your money moves faster than your bank can handle, tell me in the comments why. And if this story changed how you think about what a safe bank means, that's exactly what this channel is for. See you in the next one.